Question 1. Which regulator is the primary federal overseer of the securities markets in this FDIC coverage practice set? Option A, FDIC. Option B, SEC. Option C, IRS. Option D, CFTC Clearing Bank. The correct answer is option B, SEC. The SEC is the main federal agency overseeing securities markets and enforcing federal securities laws. FDIC insurance relates to bank deposits, the IRS handles tax administration, and a clearing bank is not the federal securities regulator. Question 2. How can FINRA be best described on the SIE exam for the FDIC coverage review? Option A. A federal tax agency. Option B. A self-regulatory organization for broker-dealers. Option C. A municipal issuer. Option D. A bank deposit insurer. The correct answer is option B. A self-regulatory organization for broker-dealers. FINRA is a self-regulatory organization that writes and enforces rules for broker-dealers and registered representatives. The IRS is the tax agency, FDIC insures deposits, and a municipal issuer sells municipal securities rather than regulating broker-dealers. Question 3. Why does SIPC matter when a brokerage firm fails during a FDIC coverage quiz drill? Option A. It sets the federal funds rate. Option B. It protects eligible customer securities and cash up to limits. Option C. It guarantees investors against market losses. Option D. It insures bank savings accounts. The correct answer is option B. It protects eligible customer securities and cash up to limits. SIPC protects eligible brokerage customers if a member broker-dealer fails and customer assets are missing, subject to limits. It does not prevent market losses, insure bank deposits, or control interest rate policy. Question 4. When does FDIC coverage most directly apply inside the FDIC coverage study bank? Option A. When a customer has deposits at an insured bank. Option B. When a market maker widens a spread. Option C. When a bond is downgraded by a rating agency. Option D. When a stock loses value in a brokerage account. The correct answer is option A. When a customer has deposits at an insured bank. FDIC insurance applies to eligible deposits at insured banks, not ordinary securities positions. Stock losses, bond downgrades, and market maker spreads are investment or trading risks rather than FDIC events. Question 5. Where do market makers usually add value for investors on a FDIC coverage exam prep check? Option A. By issuing new shares to the public. Option B. By guaranteeing a stock price cannot fall. Option C. By recording shareholder ownership only. Option D. By quoting bid and ask prices to support liquidity. The correct answer is option D. By quoting bid and ask prices to support liquidity. Market makers support liquidity by standing ready to buy and sell at quoted bid and ask prices. Issuers sell securities, transfer agents maintain ownership records, and no market participant guarantees that stock prices cannot decline. Question 6. Who usually helps an issuer sell new securities to investors in this FDIC coverage practice set? Option A. Retail customer. Option B. Underwriter. Option C. Custodian bank only. Option D. Transfer agent. The correct answer is option B. Underwriter. An underwriter assists an issuer with bringing new securities to market and distributing them to investors. Transfer agents handle ownership records, retail customers buy securities, and custodians hold assets rather than underwrite offerings. Question 7. If a company needs shareholder records updated, which party is most relevant for the FDIC coverage review? Option A. Market maker. Option B. Federal Reserve Board. Option C. Transfer agent. Option D. Options buyer. The correct answer is option C. Transfer agent. A transfer agent maintains ownership records, processes transfers, and supports corporate action record keeping. Market makers quote securities, the Federal Reserve influences monetary policy, and an options buyer does not maintain shareholder records. Question 8. Can a clearing firm reduce risk after a customer trade during a FDIC coverage quiz drill? Option A. Yes, by helping compare, clear, and settle trades. Option B. Yes, by promising profit on every trade. Option C. No, clearing firms only issue municipal bonds. Option D. No, clearing firms only create advertisements. The correct answer is option A. Yes, by helping compare, clear, and settle trades. Clearing firms support trade comparison, clearance, custody, and settlement functions after trades occur. They do not promise profits, mainly create advertising, or exist only to issue municipal bonds. Question 9. Does the primary market involve securities being sold by the issuer inside the FDIC coverage study bank? Option A, yes, but only after a stock split. Option B, no, only existing shares trade there. Option C, yes, newly issued securities are sold to investors. Option D, no, it is limited to foreign currency trades. The correct answer is option C, yes, newly issued securities are sold to investors. The primary market is where issuers sell new securities to investors, often through an underwriting process. Existing shares trade in the secondary market, currency trading is a different market, and stock splits are corporate actions rather than primary offerings. Question 10. Should secondary market trading be viewed as issuer financing on a FDIC coverage exam prep check? Option A. No, investors trade already issued securities with each other. Option B. Yes, because only underwriters can buy shares there. Option C. No, because securities cannot trade after issuance. Option D. Yes, every trade sends new capital to the issuer. The correct answer is option A. No, investors trade already issued securities with each other. The secondary market is where investors buy and sell already issued securities, so proceeds usually go to the selling investor. New capital is raised in the primary market, underwriters are not the only buyers, and securities can trade after issuance. Question 11. Before identifying the third market, which trading idea should stand out in this FDIC coverage practice set? Option A. Mutual fund shares redeemed at NAV. Option B. Exchange-listed securities trading over the counter. Option C. Treasury bills sold only by auction. Option D. New issues sold directly by an issuer. The correct answer is option B. Exchange-listed securities trading over the counter. The third market involves exchange-listed securities trading away from an exchange, typically over the counter. New issues are primary market transactions, mutual fund redemptions occur with the fund, and treasury auctions are government issuance activity. Question 12. After institutions trade directly with each other, which market is being described for the FDIC coverage review? Option A. Fourth market. Option B. Issuer auction market. Option C. Physical certificate market. Option D. Primary market. The correct answer is option A. Fourth market. The fourth market refers to direct institutional trading without a traditional broker-dealer exchange role. The primary market involves new issuance, an issuer auction is not the same concept, and physical certificates are a form of security delivery rather than a market type. Question 13. During monetary policy discussions, which institution is central during a FDIC coverage quiz drill? Option A. Transfer agent. Option B. Municipal Securities Rulemaking Board. Option C. Federal Reserve Board. Option D. Options Clearing Corporation. The correct answer is option C. Federal Reserve Board. The Federal Reserve Board is central to monetary policy, including actions that affect interest rates and money supply. MSRB writes municipal securities rules, transfer agents manage ownership records, and OCC clears listed options. Question 14. For fiscal policy, which action is the clearest example inside the FDIC coverage study bank? Option A. A broker-dealer quotes a wider bid-ask spread. Option B. Congress changes government spending or taxation. Option C. A mutual fund calculates NAV. Option D. A market maker accepts a limit order. The correct answer is option B. Congress changes government spending or taxation. Fiscal policy involves government spending and taxation decisions, usually made by Congress and the executive branch. Bid-ask spreads, mutual fund NAV calculations, and order handling are securities market activities rather than fiscal policy. Question 15. Under rising interest rates, what generally happens to outstanding bond prices on a FDIC coverage exam prep check? Option A. They always rise above PAR. Option B. They become risk-free. Option C. They stop paying coupons. Option D. They tend to fall. The correct answer is option D. They tend to fall. Bond prices generally move inversely to interest rates, so existing bonds tend to fall when rates rise. Bonds do not always rise above PAR, do not become risk-free, and normally continue paying coupons unless the issuer defaults or terms differ. Question 16. Within financial statements, which report shows assets, liabilities, and equity in this FDIC coverage practice set? Option A. Prospectus supplement. Option B. Balance sheet. Option C. Income statement. Option D. Trade confirmation. The correct answer is option B. Balance sheet. A balance sheet shows a company's assets, liabilities, and owner's equity at a point in time. An income statement reports revenues and expenses, a trade confirmation confirms a transaction, and a prospectus supplement updates offering information. Question 17. Behind a company earnings review, which statement focuses on revenues and expenses for the FDIC coverage review? Option A, balance sheet. Option B, customer account statement. Option C, income statement. Option D, order ticket. The correct answer is option C, income statement. An income statement summarizes revenues, expenses, and profit or loss over a period. A balance sheet shows financial position, an order ticket documents an order, and an account statement summarizes customer holdings and activity. Question 18. Compared with a recession trough, which phase usually signals improving business activity during a FDIC coverage quiz drill? Option A, contraction. Option B, liquidation. Option C, default. Option D, expansion. The correct answer is option D, expansion. Expansion is the business cycle phase associated with improving output, employment, and economic activity. Contraction is weakening activity, liquidation is winding down assets, and default is failure to meet an obligation. Question 19. Between public news and private tips, which phrase signals illegal insider trading risk inside the FDIC coverage study bank? Option A, a listed option contract with a strike price. Option B, material non-public information used in breach of a duty. Option C, a published annual report read by all investors. Option D, a mutual fund prospectus delivered on time. The correct answer is option B, material non-public information used in breach of a duty. Illegal insider trading risk centers on trading while possessing material non-public information in violation of a duty. Public reports, option contract terms, and proper prospectus delivery do not create that insider trading violation by themselves. Question 20. Among offering types, which one sells shares to the public for the first time on a FDIC coverage exam prep check? Option A, stock split. Option B, initial public offering. Option C, secondary market trade. Option D, dividend reinvestment. The correct answer is option B, initial public offering. An initial public offering is the first public sale of a company's shares. A stock split changes share count, a secondary market trade occurs between investors, and dividend reinvestment uses dividends to buy more shares. Question 21. A cross-firm commitment underwriting, who assumes the risk of unsold shares in this FDIC coverage practice set? Option A, underwriter. Option B, transfer agent. Option C, rating agency. Option D, retail buyer. The correct answer is option A, underwriter. In a firm commitment underwriting, the underwriter buys the securities from the issuer and assumes resale risk. Transfer agents record ownership, retail buyers purchase securities, and rating agencies assess creditworthiness. Question 22. Regarding best efforts offerings, what is the underwriter mainly promising for the FDIC coverage review? Option A, to buy the entire issue for its own account. Option B, to use reasonable effort to sell the issue. Option C, to set monetary policy for the market. Option D, to guarantee a profit to every investor. The correct answer is option B, to use reasonable effort to sell the issue. In a best efforts offering, the underwriter agrees to use reasonable effort to sell securities but does not guarantee the entire issue will be sold. Firm commitment involves buying the issue, investment profits are never guaranteed, and monetary policy is a Federal Reserve function. Question 23. Considering shelf registration, what is the main benefit for an issuer during a FDIC coverage quiz drill? Option A, it changes common stock into debt automatically. Option B, it guarantees a fixed market price. Option C, it allows securities to be registered for later sale. Option D, it eliminates all disclosure obligations forever. The correct answer is option C, it allows securities to be registered for later sale. Shelf registration lets an eligible issuer register securities and sell them later when market conditions are favorable. It does not eliminate disclosure requirements, guarantee market prices, or automatically convert equity into debt. Question 24. Suppose an investor wants key details about a new public offering, which document is central inside the FDIC coverage study bank? Option A, prospectus. Option B, customer complaint form. Option C, proxy ballot only. Option D, margin agreement. The correct answer is option A, prospectus. A prospectus provides material information about a registered offering so investors can make informed decisions. Proxy ballots relate to shareholder voting, complaint forms document grievances, and margin agreements govern borrowing in a margin account. Question 25. Imagine Regulation D is being tested, which concept is most likely involved on a FDIC coverage exam prep check? Option A, private placement exemptions. Option B, mutual fund NAV pricing only. Option C, proxy voting deadlines only. Option D, FDIC deposit insurance. The correct answer is option A, private placement exemptions. Regulation D is associated with private offerings that may be exempt from full SEC registration. FDIC insurance, proxy deadlines, and mutual fund NAV pricing are separate topics. Question 26. Assume a shareholder owns common stock, which right is commonly expected in this FDIC coverage practice set? Option A, first claim before creditors in liquidation. Option B, guaranteed dividend payments. Option C, insurance against market losses. Option D, voting on certain corporate matters. The correct answer is option D, voting on certain corporate matters. Common shareholders commonly have voting rights on important corporate matters. Dividends are not guaranteed, creditors and preferred holders have higher liquidation priority, and market losses are not insured. Question 27. Given liquidation priority, which security usually stands ahead of common stock for the FDIC coverage review? Option A, preferred stock. Option B, common stock. Option C, voting proxy. Option D, warrant. The correct answer is option A, preferred stock. Preferred stock generally has a higher claim than common stock in liquidation and often has dividend preference. Common stock is junior, warrants are rights to buy securities, and a voting proxy is not a security with liquidation priority. Question 28. Based on convertibility, what can convertible preferred shares usually become during a FDIC coverage quiz drill? Option A, customer complaints. Option B, bank deposits. Option C, treasury bills. Option D, common shares. The correct answer is option D, common shares. Convertible preferred stock can usually be exchanged for a stated number of common shares. Bank deposits, treasury bills, and customer complaints are unrelated to preferred stock conversion features. Question 29. Since rights are issued to current shareholders, what do they usually allow inside the FDIC coverage study bank? Option A, receiving FDIC protection on stock. Option B, borrowing money from a broker with no margin rules. Option C, avoiding all federal securities laws. Option D, buying additional shares before the public at a set price. The correct answer is option D, buying additional shares before the public at a set price. Rights usually let existing shareholders buy additional shares, often at a subscription price and before a public sale. They do not remove margin rules, insure stock against loss, or exempt investors from securities laws. Question 30. Once Form U4 is filed, what purpose does it mainly serve on a FDIC coverage exam prep check? Option A, guaranteeing a customer against investment losses. Option B, creating a stock split record date. Option C, registering or updating an associated person's industry information. Option D, redeeming mutual fund shares at NAV. The correct answer is option C, registering or updating an associated person's industry information. Form U4 is used to register an associated person and disclose required background information. Mutual fund redemptions, investment guarantees, and stock split record dates are unrelated to Form U4. Question 31. Unless Form U5 is understood, what event does it most directly report in this FDIC coverage practice set? Option A, termination of a registered person's association with a firm. Option B, declaring a corporate dividend. Option C, pricing an exchange-traded fund. Option D, opening a new cash account. The correct answer is option A, termination of a registered person's association with a firm. Form U5 is used to terminate a registered person's association and report required termination information. Cash account openings, dividends, and ETF pricing are handled through different documents or processes. Question 32. While bond yields rise, which price relationship should be remembered for the FDIC coverage review? Option A, bond prices always equal coupon rate. Option B, bond prices generally decline. Option C, bond prices must convert into stock. Option D, bond prices become unrelated to rates. The correct answer is option B, bond prices generally decline. Bond prices generally move inversely to yields, so prices tend to decline when yields rise. Prices are not the same as coupon rates. Rates are highly relevant to bond pricing, and conversion only applies to convertible securities. Question 33. Whenever a bond pays stated interest, which term names that stated rate during a FDIC coverage quiz drill? Option A, NAV. Option B, bid price. Option C, coupon rate. Option D, expense ratio. The correct answer is option C, coupon rate. The coupon rate is the stated interest rate the issuer pays on a bond's par value. Bid price is a purchase quote, NAV is fund value per share, and expense ratio measures fund operating costs. Question 34. Although market prices fluctuate, what is the usual PAR value of a corporate bond inside the FDIC coverage study bank? Option A, $10. Option B, $1. Option C, $100,000. Option D, $1,000. The correct answer is option D, $1,000. Corporate bonds are commonly quoted with a $1,000 PAR value for exam purposes. The other amounts may appear in other contexts, but they are not the standard corporate bond PAR value tested on the SIE. Question 35. Because Treasury bills are short-term, how are they commonly issued on a FDIC coverage exam prep check? Option A. With mutual fund breakpoints. Option B. With voting rights. Option C. As preferred stock. Option D. At a discount from face value. The correct answer is option D. At a discount from face value. Treasury bills are short-term government obligations commonly issued at a discount and mature at face value. They do not carry voting rights, are not preferred stock, and do not involve mutual fund breakpoint pricing. Question 36. Beyond corporate bonds, which municipal bond is backed by taxing power in this FDIC coverage practice set? Option A, convertible debenture. Option B, revenue bond. Option C, exchange-traded note. Option D, general obligation bond. The correct answer is option D, general obligation bond. A general obligation municipal bond is backed by the issuer's taxing power and credit. Revenue bonds rely on project revenues, convertible debentures are corporate debt, and ETNs are unsecured debt products linked to an index or benchmark. Question 37. Near a toll road financing, which municipal bond type is most likely for the FDIC coverage review? Option A, banker's acceptance. Option B, revenue bond. Option C, treasury bond. Option D, general obligation bond. The correct answer is option B, revenue bond. A revenue bond is paid from revenue generated by a specific project, such as tolls from a toll road. General obligation bonds rely on taxes, treasury bonds are federal government debt, and bankers' acceptances are money market instruments. Question 38. Inside a credit risk question, which event is the biggest concern during a FDIC coverage quiz drill? Option A, proxy mailing. Option B, dividend record date. Option C, stock split. Option D, issuer default. The correct answer is option D, issuer default. Credit risk is the risk that an issuer cannot meet its payment obligations, including interest or principal. Stock splits, proxy mailings, and record dates are corporate or administrative events rather than default risk. Question 39. Outside normal maturity, what does a callable bond allow the issuer to do inside the FDIC coverage study bank? Option A, remove all interest rate risk. Option B, convert every bond into a bank deposit. Option C, force investors to vote. Option D, redeem the bond before maturity. The correct answer is option D, redeem the bond before maturity. A callable bond allows the issuer to redeem the bond before maturity according to the bond's terms. Calling a bond does not create voting rights, convert it into a deposit, or eliminate interest rate risk for investors. Question 40. Through front running, what improper action is being tested on a FDIC coverage exam prep check? Option A, trading ahead of a known customer block order. Option B, buying a mutual fund at NAV. Option C, filing an accurate Form U4. Option D, holding a diversified portfolio. The correct answer is option A, trading ahead of a known customer block order. Front running involves improperly trading ahead of a known customer block order that could affect the market price. Mutual fund purchases at NAV, diversification, and accurate registration filings are not front running. Question 41. Around options basics, what does a call option give the buyer in this FDIC coverage practice set? Option A, ownership of a bond coupon. Option B, the right to buy the underlying security. Option C, FDIC insurance on shares. Option D, the obligation to sell stock short. The correct answer is option B, the right to buy the underlying security. A call option gives the buyer the right, not the obligation, to buy the underlying security at the strike price. It is not an obligation to sell short, a bond coupon, or insurance on stock ownership. Question 42. Alongside calls, what does a put option give the buyer for the FDIC coverage review? Option A, the guarantee of a dividend. Option B, the right to receive bank interest. Option C, the duty to underwrite an IPO. Option D, the right to sell the underlying security. The correct answer is option D, the right to sell the underlying security. A put option gives the buyer the right to sell the underlying security at the strike price. It does not create bank interest, underwriter duties, or guaranteed dividends. Question 43. Following an option purchase, what is the premium during a FDIC coverage quiz drill? Option A. The price paid for the option contract. Option B. The record date for a dividend. Option C. The PAR value of a bond. Option D. The annual fee charged by FINRA. The correct answer is option A. The price paid for the option contract. The premium is the price the option buyer pays to acquire the contract. Bond PAR value, FINRA fees, and dividend record dates are separate concepts. Question 44. Unlike market price, what does an option strike price define inside the FDIC coverage study bank? Option A. The customer's tax bracket. Option B. The fund's net asset value. Option C. The exercise price of the option. Option D. The bond's credit rating. The correct answer is option C. The exercise price of the option. The strike price is the price at which the option can be exercised. NAV, credit rating, and tax bracket are unrelated to the contractual exercise price. Question 45. Similar to IPO restrictions, who may be limited from buying certain new issues on a FDIC coverage exam prep check? Option A. Only transfer agents recording shares. Option B. Every unaffiliated retail investor. Option C. Only municipal issuers. Option D. Restricted persons associated with broker-dealers. The correct answer is option D. Restricted persons associated with broker-dealers. FINRA new issue restrictions can limit purchases by restricted persons, including many broker-dealer associated persons. The rule does not ban every retail investor, and municipal issuers or transfer agents are not the central buyer category being tested. Question 46. Instead of being uncovered, what backs a covered call in this FDIC coverage practice set? Option A. A long position in the underlying stock. Option B. A short position in unrelated bonds. Option C. A checking account only. Option D. A customer complaint file. The correct answer is option A. A long position in the underlying stock. A covered call is backed by owning the underlying stock against the short call obligation. Unrelated bonds, checking accounts, and complaint files do not cover the delivery obligation on the call. Question 47. Beside an options account opening, which disclosure is most associated with listed options for the FDIC coverage review? Option A. Official statement only. Option B. Options disclosure document. Option C. FDIC insurance brochure. Option D. Form U5 termination notice. The correct answer is option B. Options disclosure document. The options disclosure document explains standardized options risks and characteristics for options customers. Official statements relate to municipal offerings, FDIC brochures relate to deposits, and Form U5 concerns registration termination. Question 48. Beneath mutual fund pricing, what does NAV represent during a FDIC coverage quiz drill? Option A. The commission charged by a market maker. Option B. Assets minus liabilities divided by shares outstanding. Option C. The highest price paid that day on an exchange. Option D. The bond coupon divided by PR only. The correct answer is option B. Assets minus liabilities divided by shares outstanding. NAV is calculated as fund assets minus liabilities divided by shares outstanding. It is not the day's exchange high, a market maker commission, or only a bond coupon calculation. Question 49. Above open-end fund pricing, how do closed-end fund shares usually trade inside the FDIC coverage study bank? Option A. Only by redemption at NAV. Option B. On an exchange at market prices. Option C. Only through FDIC-insured accounts. Option D. Only through treasury auctions. The correct answer is option B. On an exchange at market prices. Closed-end fund shares generally trade on exchanges at market prices that can be above or below NAV. Open-end mutual funds redeem at NAV, and FDIC accounts or treasury auctions are unrelated distribution methods. Question 50. Against market integrity, which description best fits a pump and dump scheme on a FDIC coverage exam prep check? Option A. Buying shares after reading a filed prospectus. Option B. Reducing a mutual fund sales charge at a breakpoint. Option C. Settling a regular way stock trade on schedule. Option D. Spreading hype to raise a price before selling inflated shares. The correct answer is option D. Spreading hype to raise a price before selling inflated shares. A pump and dump scheme uses misleading promotion to inflate a security's price before selling into the artificial demand. Prospectus review, breakpoint pricing, and normal settlement are legitimate concepts, not manipulation schemes. Question 51. Toward mutual fund sales charges, which share class commonly has a front-end load in this FDIC coverage practice set? Option A. Preferred shares. Option B. Class A shares. Option C. Class B shares only. Option D. Treasury shares. The correct answer is option B. Class A shares. Class A mutual fund shares commonly charge a front-end sales load. Class B shares have historically been associated with deferred sales charges, while treasury shares and preferred shares are corporate equity concepts rather than mutual fund share classes. Question 52. From breakpoint pricing, what happens when a mutual fund purchase reaches a breakpoint for the FDIC coverage review? Option A. The shares become municipal bonds. Option B. The sales charge percentage is reduced. Option C. The investment becomes FDIC-insured. Option D. The fund stops calculating NAV. The correct answer is option B. The sales charge percentage is reduced. A breakpoint reduces the sales charge percentage when qualifying mutual fund purchases reach certain dollar levels. It does not create FDIC insurance and NAV calculations or convert shares into municipal bonds. Question 53. Into right of accumulation rules, what may help investors receive lower sales charges during a FDIC coverage quiz drill? Option A. Filing a suspicious activity report. Option B. Combining current and past eligible fund holdings. Option C. Buying only treasury bills. Option D. Avoiding all prospectus delivery. The correct answer is option B. Combining current and past eligible fund holdings. Rights of accumulation can let investors combine eligible holdings to qualify for reduced mutual fund sales charges. SAR filing, treasury bill purchases, and skipping prospectus delivery do not create breakpoint eligibility. Question 54. About a letter of intent, what does the customer usually state inside the FDIC coverage study bank? Option A. A promise that no risk exists. Option B. A guarantee to underwrite shares. Option C. An intention to invest enough to qualify for a breakpoint. Option D. A request to terminate registration. The correct answer is option C. An intention to invest enough to qualify for a breakpoint. A letter of intent states the investor's intention to invest enough over a permitted period to qualify for a mutual fund breakpoint. It does not guarantee no risk, terminate registration, or create an underwriting commitment. Question 55. Concerning 529 plans, what is their primary purpose on a FDIC coverage exam prep check? Option A. Insuring brokerage accounts against losses. Option B. Saving for qualified education expenses. Option C. Speculating on short-term options only. Option D. Replacing all retirement accounts. The correct answer is option B. Saving for qualified education expenses. 529 plans are designed to help save for qualified education expenses with potential tax advantages. They are not option speculation accounts, brokerage insurance, or replacements for all retirement accounts. Question 56. Relating to continuing education, which two parts are commonly tested in this FDIC coverage practice set? Option A. Coupon element and PAR element. Option B. Regulatory element and firm element. Option C. Primary element and secondary element. Option D. Bid element and ask element. The correct answer is option B. Regulatory element and firm element. Continuing education is commonly tested as having a regulatory element and a firm element. Bid and ask quotes, coupon and PAR values, and primary and secondary markets are separate SIE topics. Question 57. Reviewing DPPs, which feature should raise a liquidity concern for the FDIC coverage review? Option A. They trade intraday like large-cap stocks. Option B. They have no tax reporting. Option C. They are FDIC-insured deposits. Option D. They are generally illiquid. The correct answer is option D. They are generally illiquid. Direct participation programs are often unlisted and generally illiquid, making resale difficult. They do not trade like liquid large-cap stocks, are not FDIC-insured deposits, and can involve complex tax reporting. Question 58. Studying rights, what do they primarily invest in during a FDIC coverage quiz drill? Option A. Insurance policies only. Option B. Real estate equity or debt. Option C. Only treasury bills. Option D. Customer margin loans only. The correct answer is option B. Real estate equity or debt. Rights invest primarily in real estate equity, mortgages, or related real estate assets. Treasury bills, customer margin loans, and insurance policies do not describe the core REIT investment focus. Question 59. Testing hedge fund basics. Which trade is commonly expected inside the FDIC coverage study bank? Option A. FDIC insurance on fund shares. Option B. No investment risk. Option C. Limited liquidity and higher minimums. Option D. Daily redemption at mutual fund NAV. The correct answer is option C. Limited liquidity and higher minimums. Hedge funds commonly have limited liquidity, higher minimum investments, and private offering characteristics. Daily NAV redemption describes open-end mutual funds. FDIC insurance does not apply to hedge fund shares and risk still exists. Question 60. Checking exchange-traded products. How are ETFs and ETNs commonly accessed on a FDIC coverage exam prep check? Option A. They are always redeemed only once daily at NAV. Option B. They are insured bank savings deposits. Option C. They generally trade on exchanges during the trading day. Option D. They are customer complaint forms. The correct answer is option C. They generally trade on exchanges during the trading day. ETFs and ETNs are exchange-traded products that investors generally buy and sell on exchanges during the trading day. Once daily NAV redemption describes open-end mutual funds, while bank deposits and complaint forms are unrelated. Question 61. Measuring MSRB rules. Which market is the main focus in this FDIC coverage practice set? Option A. Municipal securities activity. Option B. Corporate income tax filing. Option C. FDIC bank deposit insurance. Option D. Foreign currency exchange only. The correct answer is option A. Municipal securities activity. The MSRB writes rules for municipal securities dealers, municipal advisors, and related municipal market activity. Tax filing, FDIC insurance, and foreign currency exchange are not the MSRB's main regulatory focus. Question 62. Identifying capital risk. What is the investor worried about losing for the FDIC coverage review? Option A. Only dividend dates. Option B. Only voting rights. Option C. Only a proxy statement. Option D. The invested principal. The correct answer is option D. The invested principal. Capital risk is the risk of losing some or all of the amount invested. Voting rights, dividend dates, and proxy statements are not the investor's invested principal. Question 63. Spotting gifts and gratuities rules. What is the core concern during a FDIC coverage quiz drill? Option A. Pricing treasury bills at auction. Option B. Changing a mutual fund's NAV formula. Option C. Calculating a stock split ratio. Option D. Improperly influencing employees of others. The correct answer is option D. Improperly influencing employees of others. Gifts and gratuities rules are designed to prevent improper influence over employees of other firms or organizations. Stock split math, treasury auction pricing, and mutual fund NAV calculations are separate operational or product topics. Question 64. Choosing inflation risk. Which investment problem is being tested inside the FDIC coverage study bank? Option A. A stock split increases share count. Option B. Purchasing power declines over time. Option C. A market order executes immediately. Option D. A customer opens a trust account. The correct answer is option B. Purchasing power declines over time. Inflation risk is the risk that rising prices reduce the purchasing power of investment returns. Market orders, trust accounts, and stock splits do not directly define loss of purchasing power. Question 65. Selecting outside business activities. What should a registered person generally provide on a FDIC coverage exam prep check? Option A. Prior written notice to the firm. Option B. A promise to ignore firm supervision. Option C. A guarantee of customer profits. Option D. A secret personal account only. The correct answer is option A. Prior written notice to the firm. Outside business activities generally require prior written notice so the firm can evaluate and supervise potential conflicts. Profit guarantees, secret accounts, and avoiding supervision are not acceptable responses. Question 66. Matching liquidity risk. Which warning sign fits best in this FDIC coverage practice set? Option A. A fixed voting deadline. Option B. Difficulty selling quickly at a fair price. Option C. A guaranteed gain from market timing. Option D. An automatic tax exemption for all products. The correct answer is option B. Difficulty selling quickly at a fair price. Liquidity risk means an investor may not be able to sell an investment quickly at a fair price. Guaranteed gains, voting deadlines, and universal tax exemptions are not liquidity risk definitions. Question 67. Calculating market risk. What kind of risk affects broad securities prices for the FDIC coverage review? Option A. Unsystematic company-specific risk only. Option B. FDIC coverage risk. Option C. Systematic risk. Option D. Transfer agent record risk. The correct answer is option C. Systematic risk. Market risk is systematic risk that affects broad markets or asset classes. Company-specific risk is unsystematic, while FDIC and transfer agent issues do not define broad market price risk. Question 68. Estimating non-systematic risk. Which method can reduce it during a FDIC coverage quiz drill? Option A. Using only market rumors. Option B. Ignoring customer objectives. Option C. Diversification across securities and sectors. Option D. Putting all funds in one stock. The correct answer is option C. Diversification across securities and sectors. Diversification can reduce company-specific or non-systematic risk by spreading exposure. Concentration, ignoring objectives, and relying on rumors can increase risk or violate sound practice. Question 69. Reading hedging questions. What is the main purpose of a hedge inside the FDIC coverage study bank? Option A. To guarantee the highest possible return. Option B. To reduce or offset risk exposure. Option C. To avoid account documentation. Option D. To eliminate all rules on trading. The correct answer is option B. To reduce or offset risk exposure. A hedge is designed to reduce or offset a specific risk exposure. It does not guarantee maximum returns, remove trading rules, or eliminate account documentation requirements. Question 70. Interpreting a market order. What is the customer prioritizing on a FDIC coverage exam prep check? Option A. A specific minimum or maximum price. Option B. A dividend record date. Option C. A reduced mutual fund sales load. Option D. Immediate execution. The correct answer is option D. Immediate execution. A market order prioritizes prompt execution at the best available price. Limit prices, dividend dates, and mutual fund sales loads are separate issues. Question 71. Tracking a limit order. What condition must be satisfied in this FDIC coverage practice set? Option A. Execution at the limit price or better. Option B. Execution at any available price. Option C. Immediate conversion into a bond. Option D. Automatic cancellation of all dividends. The correct answer is option A. Execution at the limit price or better. A limit order executes only at the specified limit price or a better price. It does not guarantee execution at any price, affect dividends, or convert securities. Question 72. Comparing stop orders. What happens after the stop price is triggered for the FDIC coverage review? Option A. The order becomes a dividend. Option B. The order generally becomes a market order. Option C. The order becomes a prospectus. Option D. The order guarantees the stop price. The correct answer is option B. The order generally becomes a market order. A standard stop order generally becomes a market order once the stop price is reached or passed. It does not become a prospectus, guarantee the exact stop price, or create a dividend. Question 73. Distinguishing GTC orders. What does good till cancelled mean during a FDIC coverage quiz drill? Option A. The order is always a market order. Option B. The order applies only to mutual funds. Option C. The order must execute only at the opening bell. Option D. The order remains open until cancelled or executed, subject to firm rules. The correct answer is option D. The order remains open until cancelled or executed, subject to firm rules. A good till cancelled order remains active until it is executed or cancelled, subject to firm and exchange time limits. It is not limited to the opening, not always a market order, and not only for mutual funds. Question 74. Recognizing the bid quote. What does it show inside the FDIC coverage study bank? Option A. The price a dealer is willing to pay to buy. Option B. The price a customer must pay for a prospectus. Option C. The PAR value of a municipal bond only. Option D. The annual dividend rate only. The correct answer is option A. The price a dealer is willing to pay to buy. The bid is the price a dealer or market maker is willing to pay to buy a security. Prospectus costs, dividend rates, and PAR value do not define the bid quote. Question 75. Noticing the ask quote. What does it show on a FDIC coverage exam prep check? Option A. The amount of FDIC insurance available. Option B. The maximum gift limit only. Option C. The price a dealer is willing to accept to sell. Option D. The date a U5 is filed. The correct answer is option C. The price a dealer is willing to accept to sell. The ask is the price at which a dealer or market maker is willing to sell. FDIC insurance, gift limits, and Form U5 filings are unrelated to the ask quote. Question 76. Evaluating agency capacity. How is the broker-dealer acting in this FDIC coverage practice set? Option A. As the customer's tax authority. Option B. As the issuer of the security. Option C. As an agent arranging a trade for the customer. Option D. As a bank deposit insurer. The correct answer is option C. As an agent arranging a trade for the customer. In agency capacity, the broker-dealer acts on behalf of the customer and may charge a commission. The broker-dealer is not the issuer, tax authority, or deposit insurer in that capacity. Question 77. Assessing principal capacity. How is the broker-dealer acting for the FDIC coverage review? Option A. Only filing tax returns. Option B. Only calculating GDP. Option C. Trading from or into its own inventory. Option D. Only mailing proxy statements. The correct answer is option C. Trading from or into its own inventory. In principal capacity, the broker-dealer buys from or sells to the customer from its own inventory and may charge a markup or markdown. Proxy mailing, GDP calculation, and tax filing do not define principal trading capacity. Question 78. Verifying a long stock position. What does the investor own during a FDIC coverage quiz drill? Option A. A municipal official statement. Option B. Shares purchased and held. Option C. Shares borrowed and sold. Option D. A put contract only. The correct answer is option B. Shares purchased and held. A long stock position means the investor owns shares. Borrowing and selling shares describes short selling, while a put contract and an official statement are different instruments or documents. Question 79. Confirming a short sale. What is the investor initially doing inside the FDIC coverage study bank? Option A. Redeeming mutual fund shares at NAV. Option B. Buying a certificate of deposit. Option C. Selling borrowed shares. Option D. Receiving a guaranteed dividend. The correct answer is option C. Selling borrowed shares. A short sale starts with selling borrowed shares with the expectation of buying them back later. CDs, mutual fund redemptions, and guaranteed dividends are not short sale mechanics. Question 80. Clarifying private securities transactions. What is the key compliance step on a FDIC coverage exam prep check? Option A. Providing required written notice and obtaining approval when required. Option B. Keeping the activity hidden from the firm. Option C. Routing it only through a personal email account. Option D. Calling it a dividend to avoid review. The correct answer is option A. Providing required written notice and obtaining approval when required. Private securities transactions require proper written notice and, when compensation is involved, firm approval and supervision. Hiding the activity, relabelling it, or using personal email to avoid review creates compliance problems. Question 81. Separating statutory disqualification. Which issue can affect association with a firm in this FDIC coverage practice set? Option A. Owning a diversified mutual fund. Option B. Receiving a routine trade confirmation. Option C. Certain criminal, regulatory, or misconduct events. Option D. Reading an official statement. The correct answer is option C. Certain criminal, regulatory, or misconduct events. Statutory disqualification can arise from serious criminal, regulatory, or misconduct events and may restrict association with a member firm. Diversified investing, trade confirmations, and reading offering documents are not statutory disqualification events. Question 82. Linking unregistered persons to commissions. What practice is generally prohibited for the FDIC coverage review? Option A. Calculating a bond's coupon payment. Option B. Sending a customer an account statement. Option C. Paying transaction-based compensation to unregistered persons. Option D. Quoting a bid and ask spread. The correct answer is option C. Paying transaction-based compensation to unregistered persons. Firms generally may not pay transaction-based compensation to unregistered persons for securities business. Account statements, market quotes, and coupon calculations are not the prohibited payment practice. Question 83. Mapping customer complaints. Why must firms track written complaints during a FDIC coverage quiz drill? Option A. They replace all trade confirmations. Option B. They automatically guarantee customer reimbursement. Option C. They can trigger record-keeping and reporting obligations. Option D. They convert common stock into preferred stock. The correct answer is option C. They can trigger record-keeping and reporting obligations. Written customer complaints can create record-keeping, supervisory, and reporting obligations for firms. They do not automatically guarantee reimbursement, replace confirmations, or change the type of security owned. Question 84. Framing a 2-for-1 stock split, what usually happens to share count and price per share inside the FDIC coverage study bank? Option A. Shares double and price per share is adjusted downward. Option B. Shares disappear and price becomes zero. Option C. Shares gain FDIC insurance. Option D. Shares become bonds automatically. The correct answer is option A. Shares double and price per share is adjusted downward. In a 2-for-1 split, the number of shares doubles and the price per share is adjusted downward, so total value is generally unchanged at the split moment. Shares do not disappear, become bonds, or receive FDIC insurance. Question 85. Discovering senior exploitation concerns, what should firms be alert to on a FDIC coverage exam prep check? Option A. Only normal dividend declarations. Option B. Only Treasury auction schedules. Option C. Only routine ETF expense ratios. Option D. Possible financial exploitation of specified adults. The correct answer is option D. Possible financial exploitation of specified adults. Firms should be alert to signs of possible financial exploitation involving seniors and other specified adults. ETF expenses, dividend declarations, and Treasury schedules are ordinary investment topics rather than exploitation red flags. Question 86. Remembering regular way stock settlement, which timeframe is generally tested now in this FDIC coverage practice set? Option A. Same day for all securities. Option B. T+1. Option C. Only at month end. Option D. T+5. The correct answer is option B. T+1. Regular way settlement for many securities transactions is generally tested as T+1. T+5, universal same-day settlement, and month-end only settlement do not match the current common SIE settlement concept. Question 87. Learning political contribution rules, which business risk can excessive contributions create for the FDIC coverage review? Option A. Guaranteed IPO allocation. Option B. Restrictions on municipal securities business. Option C. A higher FDIC insurance limit. Option D. Automatic SIPC reimbursement. The correct answer is option B. Restrictions on municipal securities business. Political contribution rules can restrict municipal securities business when covered contributions exceed permitted thresholds. SIPC reimbursement, IPO allocations, and FDIC limits are unrelated to political contribution restrictions. Question 88. Predicting cash account requirements, what must the customer do during a FDIC coverage quiz drill? Option A. Avoid all trade confirmations. Option B. Pay fully for purchases. Option C. Short every position. Option D. Borrow automatically from the broker. The correct answer is option B. Pay fully for purchases. A cash account requires the customer to pay in full for securities purchases. Borrowing is a margin account feature, shorting is not required, and confirmations are still part of customer communications. Question 89. Explaining margin accounts, what feature makes them different from cash accounts inside the FDIC coverage study bank? Option A. Customers avoid all suitability rules. Option B. Customers receive guaranteed gains. Option C. Customers become issuers of securities. Option D. Customers may borrow from the broker-dealer using securities as collateral. The correct answer is option D. Customers may borrow from the broker-dealer using securities as collateral. A margin account allows a customer to borrow from the broker-dealer with securities serving as collateral. Margin does not guarantee gains, remove conduct rules, or make the customer an issuer. Question 90. Applying discretionary authority, what must a representative generally have before trading on a FDIC coverage exam prep check? Option A. Written customer authorization accepted by the firm. Option B. A dividend announcement. Option C. Only a verbal hint from a friend. Option D. A tax refund check. The correct answer is option A. Written customer authorization accepted by the firm. Discretionary trading generally requires written customer authorization and firm acceptance before the representative can decide trade details. A friend's hint, dividend news, or a tax refund does not create discretionary authority. Question 91. Solving custodial account ownership, who owns the assets under UTMA-style registration in this FDIC coverage practice set? Option A. The custodian owns the assets personally forever. Option B. The minor beneficially owns the assets. Option C. The broker-dealer owns the assets. Option D. The transfer agent owns the assets. The correct answer is option B. The minor beneficially owns the assets. In a custodial account, the minor is the beneficial owner while the custodian manages the account until the required age. The custodian, broker-dealer, and transfer agent do not personally own the assets. Question 92. Handling AML placement, what is happening in the first stage of money laundering for the FDIC coverage review? Option A. Funds are fully taxed and reported as wages. Option B. A stock split is approved. Option C. A dividend record date is set. Option D. Illicit funds enter the financial system. The correct answer is option D. Illicit funds enter the financial system. Placement is the stage where illicit funds are introduced into the financial system. Tax reporting, dividend dates, and stock split approvals do not define the first stage of money laundering. Question 93. Reporting layering, what is the money launderer trying to do during a FDIC coverage quiz drill? Option A. Calculate a mutual fund breakpoint. Option B. Set the federal funds rate. Option C. Conceal the source of funds through complex transactions. Option D. Openly disclose the illegal source. The correct answer is option C. Conceal the source of funds through complex transactions. Layering uses transactions to make the source of illicit funds harder to trace. Open disclosure, interest rate policy, and mutual fund sales charge calculations are unrelated to layering. Question 94. Filing a SAR, which situation is most relevant inside the FDIC coverage study bank? Option A. Every mutual fund purchase below $100. Option B. Every ordinary dividend payment. Option C. Any customer who asks for a prospectus. Option D. Suspicious activity that meets reporting criteria. The correct answer is option D. Suspicious activity that meets reporting criteria. A suspicious activity report is filed when suspicious activity meets the applicable reporting criteria. Ordinary dividends, prospectus requests, and small routine purchases are not automatically SAR events. Question 95. Maintaining CTR awareness, which transaction generally triggers the report on a FDIC coverage exam prep check? Option A. Cash transactions over $10,000 in one business day. Option B. Any stock trade over $100. Option C. Every online login attempt. Option D. A quarterly account statement. The correct answer is option A. Cash transactions over $10,000 in one business day. A currency transaction report generally applies to cash transactions over $10,000 in one business day. Stock trade value, login attempts, and account statements do not define the CTR trigger. Question 96. Protecting against OFAC violations, what must firms screen for in this FDIC coverage practice set? Option A. Only mutual fund expense ratios. Option B. Only option strike prices. Option C. Sanctioned persons and blocked entities. Option D. Only stock dividend rates. The correct answer is option C. Sanctioned persons and blocked entities. Firms must screen for sanctioned persons and blocked entities to avoid prohibited transactions. Dividend rates, expense ratios, and strike prices are investment terms, not OFAC screening targets. Question 97. Preventing privacy violations, which information does Regulation SP focus on for the FDIC coverage review? Option A. Only stock split ratios. Option B. Non-public personal customer information. Option C. Only municipal coupon rates. Option D. Only Treasury auction dates. The correct answer is option B. Non-public personal customer information. Regulation SP addresses privacy and safeguarding of non-public personal customer information. Stock split ratios, Treasury auction dates, and coupon rates are securities data rather than protected customer privacy information. Question 98. Detecting KYC obligations, what must a firm reasonably know during a FDIC coverage quiz drill? Option A. Only the market maker's office address. Option B. Only the issuer's logo color. Option C. Only the customer's favorite stock symbol. Option D. Essential facts about the customer. The correct answer is option D. Essential facts about the customer. Know your customer obligations require firms to use reasonable diligence to know essential facts about each customer. Favorite symbols, logo colors, and office addresses do not satisfy the core customer information requirement. Question 99. Avoiding unsuitable recommendations, what should a representative consider inside the FDIC coverage study bank? Option A. Only the stock's ticker length. Option B, customer profile and investment objectives. Option C, only the representative's commission goal. Option D, only internet rumors. The correct answer is option B, customer profile and investment objectives. Suitability and best interest analysis require attention to the customer profile, objectives, risk tolerance, and related facts. Commission goals, rumors, and ticker length are not proper bases for recommendations. Question 100. Completing Reg by Basics. What standard applies to retail recommendations on a FDIC coverage exam prep check? Option A, acting in the retail customer's best interest. Option B, ignoring conflicts if disclosed nowhere. Option C, guaranteeing every recommendation will profit. Option D, replacing all FINRA rules. The correct answer is option A, acting in the retail customer's best interest. Regulation best interest requires broker-dealers to act in a retail customer's best interest when making recommendations. It does not guarantee profits, allow undisclosed conflicts to be ignored, or replace all FINRA obligations.